how are you controlling the narrative? Like there's always goods and bads and ebbs and flows and cycles in the market and what's happening. How are we controlling the narrative with, and utilizing what's happening in the market to further your business, right? Because the market's not determined based on what actually happens. The market's determined based on what people think is going to happen. It's the perception of what they think is going to happen. So if you can change the perception, you can change 99% of what the end results are. All right, when you guys sit down with a financial advisor, what do they tell you about the stock market? Just throw out some stuff.
Over 30 years, average returns.
8% average returns, right? Over 30 years, right? Long term, just keep your money in, ride out the market, it'll go up over time, all those things. You know what it says about saying what the average returns are? First of all, I want to show you this. When they show you the chart and they show you what happens each year, what the returns are. So since 1930 or whatever, they always go back 80 years. And they're like, yeah, we've averaged 8% returns. And they give you this timeline, and every year it says, hey, it went up 8%, it went down 2%, it went up 26%, right? And they say average over time. They add up all these, and then they divide it by however many years it was, and then it give you an average of 8%, right? The reason they go over that, and the reason everybody's brainwashed in thinking that I make 8% if I stick my money in the market, over time, I'm going to continue to make 8%. That's the number. That's what everybody says. Somebody get out a calculator for me. I want you to take $100,000, and then I just want you to multiply it by 1.2 times 0.8 times 1.2 times 0.8 times 1.2 times 0.8. Right? So this is saying a 20% gain and then a 20% loss, and a 20% gain and a 20% loss, and a 20% gain and a 20% loss. What happens to the actual dollar amount after you do that 4, 5, or 6 times? What's the dollar amount worth? And let's say you break it back even. Let's remove that. Just break it back even. Let it go up and down, up and down, up and down. What does it actually do to your money if you do that an equal amount of times? Times 1.2 times 0.8, times 1.2 times 0.8, times 1.2 times 0.8. Just do it 6 times. 88. 473. That's an average of 0% in the market, right? Everything, if I took the averages, it averages out as 0. And it'd be like, oh, no, we averaged 0% over the past 6 years, right? And so everything, you would think you're at break even. And it doesn't even include the fees.
And they take fees whether it grows or it doesn't.
Correct. And there's fees that you don't even know about. If you look at the backside and 30 pages deep into these investment vehicles, there are fees that they never even tell you about on the surface. You know about your financial advisor's fees of 1% or 0.5% or whatever it is, but there's another about 3% of fees beyond that. So look at this. If I gave you this number and I averaged out the returns, and the average was 0% average return over time, that's not what happens to your actual money though. Every time it goes up and down and up and down and up and down, you're losing value on your dollar. So people don't realize that, plus the fees, plus everything else. I took a chart of what the gains were over the course of 20 years from 2000, well actually my buddy Dana did, from 2000 to 2020. And he took the average return every single year and multiplied it all out by if you had $100,000 in your account and how that affects your dollar amount. And he did it year by year by year by year. And then he actually reversed it and said, hey, even if it like lost money first and then gained money the second year, and just, he's played it with a couple of different things. It is better to have your money in a 4% fixed return asset than it is to have it in the stock market. This would have outperformed from 2000 to 2020. A 4% fix with zero effect on principal. So now that you're armed with that information, can you go and educate people in your network that this is how it works, and they shouldn't be putting their money in the stock market, and instead they should be putting it into your fund or your fund or your fund and making an 8% or 9% or 10% return, right? Without any, and by the way, that loss isn't they're not making 5% less on their 8% average returns. They're losing 5% of their principal, you know? It's not like a lesser of a return, it is loss of principal. And if they put their money in a fund or in one of your investment deals and they're making a fixed return on, without risking any sort of principal value, they're in a better position than if their money's in the stock market. So now you're armed with that. It's really, really powerful. You know, people saying, oh, the money is not created or lost, it's just changes hands. That's like the biggest fallacy in finance, right? But like, think about this. There's a vacant lot and you build a house on it, right? You bought the lot for 100K. You built the house for 300K, right? That's 400K, you're into it. But now it's worth 500K. What do you mean there's no value created? We just created value. And conversely, what if this house burns down and goes up in flames? That 500K is evaporated, goes away. And the value is completely lost. Now you have the lot value and that's it. So like finance does get created. Like, do you think there's just as much money or more money or less money than 3,000 years ago in ancient Egypt? There's more money today. There's more billionaires today than there were a few years ago, and there's more people, and there's more money moving around in the economy. So like, you could take an idea and take natural resources and create money and create value out of it, but we're brainwashed to say, oh, it just changes hands and the rich get richer, eat the rich, right? Like, forget these people. So it's this narrative that we've been brainwashed. And the other thing is you can also Google search Goldman Sachs. And Goldman Sachs gets paid based on selling people stocks, right? And they put something out that says don't expect more than a 3% annual return in the stock market over the next 10 years. 3%. Oh, you're going to ride out the stock market? No. All right, so it's an education piece. It's just letting people know here's what the options are. People don't even know that they could invest in real estate. They don't even understand that there's other options outside of the S&P 500.